Hey everybody, JJ. It's Tuesday, November 24th, 2020. We were right. Finally, we're right. Dow Jones hit 30,000. We've been predicting this since the big market sell-off. Remember back in March when the market took a big drop? I said, you might want to hold out here and buy the dip. And I know a lot of you out there, you've been messaging me, and I see you down in comments that you did buy the dip. And you've been heavily or handsomely rewarded. We're back. And this is a new all-time high, 30,000. It doesn't mean that it can't drop down, but overall it's an uptrend. Now what's going to happen in the future, we'll have to see, but today all major indexes in the green, big increases. Oil back up to $45. Gold and silver, a bit of a hit. Gold down near 1,800. Silver, $23.27. Also, digital assets, huge increase today. And honestly, I don't know how anyone can make it in today's world without some sort of investment. I know I would have a hard time if it weren't for the investing that I do, and I still work a regular job. But people just relying on their job, unless they have very little overhead, it's going to be very difficult to get by. Seems like for most people. And when you look at Main Street versus Wall Street, what a disconnect. I mean, this continues to get more separated as we continue to go into these bubble markets. And we see the housing market continue to explode. Let's take a look at a recent chart here. And this is the Case-Shiller year-over-year price change, and we see Phoenix leading the way. Now the blue is actually September of this year versus September of last year, and the orange is September of last year versus September of the previous year. So we see this year actually the gains have exceeded the previous year's gains. So the year-over-year gain in Phoenix was close to 11%. All right, so when you hear all this talk out of the Fed that we have a 2% inflation target, well, that inflation target is being walloped by about 5 times here when you look at the price appreciation in some of these cities. Coming in second place this year with year-over-year price appreciation, according to the Case-Shiller index, was Seattle, up over 10%. San Diego, where I'm at, about 9.5%. Los Angeles, about 7.5%. Also about the same 7.5%. We have Boston, Portland, Charlotte, Tampa. Washington, about 7%. Minneapolis, about 7%. Coming in at 6% year over year. San Francisco, Denver, Atlanta, Miami, Las Vegas, Dallas, Chicago, and New York round out the biggest gainers here year over year. So more of the same. If you've been on this channel, you know exactly what was going to happen. Bubbles can be inflated beyond your wildest imagination, even with 50 million people losing their jobs. And yes, some of those people got their jobs back, while others didn't. All right, but this is what happens when you have a centrally driven market. So you have individuals that create the money. They can infinitely liquefy the banks. So it doesn't matter how many people stop paying their mortgage. Prices can still continue to go up as long as there's new borrowers to continue to bid up the home prices. You see what I'm saying here? Do you guys understand? And in my opinion, this is similar to the subprime mortgage market that we saw in the run-up in the mid-2000s in the mega housing bubble, which we have now exceeded, by the way, when it comes to prices. And most people don't realize it because they think that the subprime mortgages are not out there. They're still out there. Underwriting guidelines have loosened tremendously, but even bigger than the subprime lending that was happening in the mid-2000s, we have now banks do not have to have any liquidity in reserves. There is no reserve requirement. So this housing bubble could get bigger unless somebody comes in, re-regulates the banks, holds the banks accountable. That means they would have to have enough money in reserves to cover all the loans that are being loaned out. That would be a 1-to-1 ratio in what the banks are lending versus what they hold in deposits. And even that really wouldn't be enough, because think about it. If you have money in reserves and then you have all these loans out there, let's say you have $10 billion in reserves, $10 billion loan liabilities. If all or half of those loans went bad and then a lot of people drew their money out of the bank, you still, even a 1-to-1 ratio may still not be enough. I think they should require banks to have a 2-to-1 ratio. That means for every dollar they loan out, they have to have 2 in reserve, right? Probably will never happen, but that would be more of a price discovery mechanism to see what can actually be afforded by the average person without the banks endlessly handing out money. And here's something that I haven't spoken about yet, but a lot of people are talking about it. We may have to look at this for the next 4 years. Right now, I'm not a fan of Jerome Powell. I'm not a fan of any Fed chairman. I think they all just spit out a bunch of basically nonsense and feel-good phrases to try to make people less concerned than they really should be about this melt up in the markets. But at the end of the day, does it really matter who sits there and spits out the lines, that they're supposed to spit out? We know they don't write their own speeches. They don't write their own speeches. And all you have to do is watch one of these conferences or one of these Q&A sessions, and basically they look down, they're reading off of a paper, so it doesn't really matter too much. The policy is going to be the same: inflate, lend, spend, and pretend that the economy's fine. Meanwhile, half the country's either waiting in a food line or on some sort of forbearance program, or waiting for their next stimulus check or unemployment check. We have more people than ever, more people that versus any time in history here in the United States, depending on some sort of assistance, be it a handout, forbearance program, forgiveness program. So if you're not riding the bull somewhere, that means you're in an asset invested somewhere where it's going to make you profits, then you may have a very difficult time. Now, there's a lot of people doing just fine that are not investing. People have very low overhead, people without high housing costs, people without kids. All right, so if you have low overhead and a minimalist lifestyle, you may be laughing this whole time watching the markets and watching all this devastation unfold. And I do see a lot of you down in comments that are doing just fine during these times because you were cautious and you were very careful about the expenses and the debt and the lifestyle that you chose to get into. But what I feel really sorry for, really scared for, is the people that do not know what's happening. They expect this economy to improve, and maybe they lost their job, and maybe they're looking to go back to work, and maybe they have kids to feed, and this is just going to be a very, very dark time unless something huge happens here in the next couple months. But at the end of the year, we had a lot of these programs expiring, and the question is, with the new administration coming in, will they just continue more of the same? Will it be some sort of other massive rescue program, maybe massive debt forgiveness? We'll have to see. We see they're already talking about student loan debt forgiveness. Will it be that? Will it be more? And will debt forgiveness fix the problem? No, because people are just going to go out and get into more debt. Why? Because when you have banks that can loan out endless amounts of money, you're only going to see asset bubbles. The demand side of the supply versus the demand is always going to be strengthened via the lending. And when you have banks that are unleashed and deregulated with no reserve requirements, it's going to be just more bubbles. And the thing about it is the institutions and the banks and the universities that profited from all these students going out and getting loans and paying for their education via loan, via debt, they get to still keep their money, right? So you have these newly created billionaires, or in some cases billionaires that just got even wealthier, like we see in most cases, profiting from the system, while the people that are borrowing are begging for debt forgiveness and begging for forbearance. They're having to set up special payment plans so they can repay their loans and maybe extend the loans out further. All right, now with the stock market being continually pumped up here, again, Dow Jones 30,000, it may give people an economic boost as far as their confidence in this economy when they see their 401k and their retirement balance. But try to go to the store and buy food with your stocks that you have in your 401k. All right, try to pay rent with the stocks you have in your 401k. In other words, if you don't cash out, it's not liquid and it's not a realized gain. It's a paper gain. And that's why I tell people, if you're up big, if you're in the green, take some off the table because who knows what could happen. This is a new level of uncertainty, to say the least, with this economy and these markets. And I wish I had better news for you, but nobody knows what's really going to come out of this. I'm not hearing any solutions being discussed. I'm hearing a lot of band-aids on a broken leg, a lot of quote-unquote solutions that will be popular with the people for for example, debt forgiveness, but it's never going to address the underlying issue. And when most people have no idea how the system really works and they're just looking for a handout, you'll probably never see any solutions implemented. So we need to protect ourselves, stay prepared. I'm still stacking silver mostly. Link down below, SD Bullion, that's where I get my silver. And if you haven't hedged yourself at least a little bit against the inflation that we could possibly be seeing coming forward, even to a higher degree than we're seeing now, you might want to rethink your strategy there. But that's going to be all for today's report. Everybody, thanks for watching. Stay well, stay safe, stay prepared.